So I've mentioned in the past videos that I'm trying to experience with zero DTE trade. So I don't want to be in the market. I don't want to be exposed in the market long enough. So I'd rather be in cash at the end of the day. So I've been looking at zero DTE trade. I've been looking at SPXW specifically, which is the index for the S&P 500, and the W is basically the weekly options. And what's great about this sticker is that it has daily expiry. So if I look at expiries here, it has every day expiry, so 5 days a week. So it's a trade I can make every day. So what I've been looking at is selling a naked put out of the money, and it's a little bit below expected move, and I'm basically picking the strike that pays me around $5. So right now, if we look at the market right now, we're June 28th. I think SPX, as you can see, SPX closed at 3,900. So that would put me at around 3880. So it's only 20 points lower. So if we compare it to the SPY, that's like saying SPY is at 390, and I'd be picking a 388 strike on the SPY expiring today. So this is definitely close, but I've been looking at it and paper trading it since the month of May. It has generated a lot of winners, enough to say that this strategy is sustainable, but I have to implement a stop loss. So I can't just sell the 3,880 put and just let it go. The stop loss would be 3 times the credit received. So if I sell the 3,880 strike for $5, then I put a stop loss of $15. So if the trade's a winner, then I win $5. Actually, I close the winners for $1. So if the trade's a winner, I close it for $1. But I set a stop loss so that it closes automatically at $15. So if the market drops, then the premium will go up. If it goes to $15, close the trade. So it's important to implement a stop loss to control your losses, because sometimes the losses can be big and wipe out all your small gains. So with this strategy that I've been trying since May, it seems to be working, but I've been paper trading it. I have started using it, trying it out with real money. So today I wanted to show you a trade that I made on June 23rd, I believe. Actually, let's go look it up here. SPXW. Account executions. Let's go SPXW. So let's look at the bottom one over here. So June 23rd. So you could see here, June 23rd, I placed, what was it? Well, let's see first what SPXW was trading on June 23rd. So 5-day chart here. Why is it not showing? Chart's not working. All right, so June 23rd, as you can see, SPX was trading at around 37.87. I went ahead and sold the 37.30 put. And as you can see at the time stamp here, I sold at 9:32, so 2 minutes after the market opened. And then I closed it at 10:21, so I closed it about 20 and 30, about 50 minutes later. And I closed it for $1.75. So I sold it for $5, closed it for $1.75. So I made $325 US in about 50 minutes in the market. Now, this ended up expiring worthless at the end of the day, so I could have made the full $5. But I mean, it's really stressful to hold this trade, and when you see a good profit, you start second guessing yourself. What if the market reverses and then you miss out on the profit? It's all mental games, but it can't complain though. Still made $325 in 50 minutes. And thing is though, it's important to respect the probabilities or the expected profit that you had plan going into the trade, because the stop loss will eventually trigger, and that $1,000 that you lose will wipe out all your profit. So I'm going into the trade. It's a bracket order that I'll show you how I set up. So I'm going into the trade saying that if I win, I win $4. If I lose $1,000. But I need to win more than 71% of the time to break even. And based on the paper trading that I've been doing since May, I've been winning, I think, 88% of the time by simply just selling a naked out of the money put that pays me $5 at around the open. Now, sometimes I'm mechanical and I just sell the first strike that pays me $5. Sometimes based on pre-market, if pre-market is red or if pre-market is green, but I saw it red earlier, then I'll put an exaggerated strike, or I'll pick a strike a bit lower, wait for the market to come back lower once it opens. So sometimes I'll be a little bit selective on the strike, and sometimes I just take the first strike available. Sometimes I miss out on the trade because the market just flies at the open, which has happened. But in terms of paper trading, I look at, what if I had picked the first strike that paid me $5? Would it have been a winner, just to test out the strategy? And like I said, since May, it's been a winner over 88% of the time. So this trade I made with real money here, June 23rd, $325 profit in 50 minutes. And this one, I believe, was entered, as you can see, 2 minutes after the open. So this one I had picked a strike a little bit lower. I didn't go for the first strike. Now the buying power required for this trade is pretty high. It's about 50,000 US. And then about, if you convert that in Canadian, it's almost 70,000. But because it's as you can see, it's a 0 DTA trade. I'm closing it the same day. I'm getting my capital back right away. So I don't care. It's the only trade I'm making anyways. And I mean, can't complain with $300. If I could do that, if I could do this every day, I can't complain, right? Even if it's using 50K US buying power. Now, it is a lot of buying power, so it's not a trade that anyone can make, but it's definitely worth looking into. You could also do it as a spread if you don't have the buying power. But then the reason I'm doing it naked is because I'm using Questrade, and to do a bracket order, Questrade, you can only do a bracket order on naked positions. You can't do it on a spread, and I need that stop loss. I need to control the loss automatically. I'm not going to be in front of the screen the whole time, so I need to set up the stop loss so that if the premium gets to $15, get out of the trade. So I max out, I cap my loss, and then I move on to the next day, and hopefully the profits compensate for that loss. So let's set up a bracket order. So the way I would set up a bracket order, basically look up the option, and then let's say I want to sell the naked put here on the 3,880. Now actually 3,880 is actually not just 20 points away. This is pre-market, but it's real numbers, because market is up a bit. If I look at the SPY is up, I think 0.6%. So you see SPY is up, so SPX W is definitely up as well. So I'm probably like 30-40 points out of the money. Or if I want to be specific here, I can see SPY is up 0.6%. So SPXW is actually currently trading at 3,900 times 1.006. So it's trading at around 39.23. So 38 to 80 is about 40 points out of the money. And it would be paying me $5 right now. So this would probably be a trade that I would take, but I would definitely set up a stop loss. Or if I want to be safer, I'll pick a lower strike, or just see. But I could see that on the SPY that pre-market was not red. If I look at 1 day here, let's look at pre-market on the SPY. Let's see if it was. Okay, so you could see, yeah, it had a low of 390 right now, so 390.86. There is a gap up here from yesterday, right? From yesterday to this morning. So there is definitely a gap up, but doesn't mean that it's going to drop and fill the gap at the open. So yeah, I would probably just, just to be safe, probably pick like a 38.75 maybe. But just to show you, just for the purposes of showing you the bracket order, I'll just pick the 38.80, and then I'll pick the price that I want to sell it at. Let's say I want to sell it for $5, and then I'll do the bracket order over here. Then click on bracket order, click on, and then this is the order to take profit. So I would put $1 here because I want to take profit at $1, and then the stop loss is what's very important. So this is when do you want your stop loss order to trigger? When do you want it to be accepted? So I would put $15. That's when I wanted it to be triggered, and the limit would be $15 or even 15.10, just to give it enough time to get accepted. So basically this means that my stop loss order will be activated once the premium reaches $15, but I want to close it for no more than $15.10. So if it doesn't reach 15.10, then the order won't close. And so that would be the way I would set up the bracket order. And this is setting it up before even sending the order. Once I set that up, then I can click send order, and then I'll have sell to open for $5. But this profit taker is only accepted or activated if the initial order gets filled. So if I actually end up selling it for $5, and then the stop loss will trigger if the premium reaches $15, and then it will close for $15.10. So that's how I would set up a bracket order here with Questrade, and that's why I'm doing this trade naked, so that I can set up a stop loss. Questrade doesn't have stop loss for spreads, and actually that's why I'm opening an interactive brokers account, so that I can do stop losses on spreads, because I don't want to be limited to only doing naked puts on for this trade, because sometimes what if SPX goes higher and it's trading at 4,000 or 4,200, it's going to require more buying power, which I might not have. So it doesn't make sense to do it naked because of the buying power. So sometimes doing it a spread would make more sense. But it's very important to have the stop loss, because the market can drop really quickly, and then your losses become too big. So I also did this trade, if you noticed, I also did this trade June 27th. This time I sent in an exaggerated order. The reason I did that is because I noticed Sunday night futures were red, and then Monday morning pre-market was green. So I expected that it would come back down to the Sunday night prices. So this was an exaggerated order at 38.50. Market opened at around 39.27 or something. So I sold a 38.50. I placed an exaggerated order at 38.50. So I placed it at 9.31, but it got filled at 9.48. So it got filled 18 minutes later when the market actually dropped after the open. It got filled at $5. But then I didn't respect my $1 profit taker. I ended up closing it myself manually for $2.50 because it was just too hard to resist. And as you can see, it was about it was 6 minutes in. So in 6 minutes, this time was a $250 US profit. Now, I think 10 minutes later, this was worth $1. So if I had just respected my stop loss and my profit taker, would have made my expected profit of $400 if I was just a bit more patient. But that's the thing. Mentally, it's very hard to. It's easier said than done, but mentally, it's hard to do in real life, especially. Paper trading is a different story, but it definitely takes some time to get used to it. But while I'm getting used to it, I don't mind making these small profits here. But thing is, like I mentioned, it's very important to respect the profit, because you will eventually take a loss of 1K, and then 1K will wipe out all these profits easily. So you need to maximize your winners. You need to extract the most profit out of your winners for this strategy to work. This is what I'm noticing, and this is what I've observed by paper trading it since May. All right, so yeah, basically just wanted to share with you this 0 DTE trade that I'm still looking into and practicing. I've done it twice with real money, but I've been paper trading it as if I'm doing it live since May. I think I've got about 30 occasions. I've done 30 occasions, and I think I've got like 3 or 4 losses on 30 occasions, which is, so let's say 26 divided by 30. So it's an 86% win rate. So that means, or let's say 26 times I win $400, but 4 times I lose 1,000. This trade is still profitable at 6,400 overall, right? But if I'm only making $300 on the winners, so times 26, but I'm still losing that $4,000, then it reduces my overall P&L. So that's why I gotta respect I gotta extract the most out of my winners. And I did notice, out of the 26 winners, if I had just let them go to expiry, they would have been 25 out of 26 would have expired worthless. Only one of them was a good thing that I closed it for $1, because that was the only one that actually reverted back and became a loser at the end of the day. But most of the time, your winners end up expiring worthless. You don't even have to close it for a dollar. So that's another thing I'm considering. What if I just place the order and just let it be, take whatever value it's worth at the end of the day, whether it's a winner or a loser, and is the overall P&L profitable? That's I'm still paper trading it on the side as well to see what if I had entered a trade mechanically without picking a strike. And what if I just let it run to expiry? See what happens. I think one of the losers would have been a $5,000 loser. So that's why I think, and $5,000 would have wiped out a lot of days, right? So I think that's why I prefer to put a stop loss and cap the loss. And only one of the losers would have been a winner if I'd held to expiry. So most of the time, it's better to take the stop loss and max out your and cap your losses, because it's not like you're missing out on gains by using a stop loss. It only happened once where the stop loss triggered would have given me a loss, but then at the end of the day, it ended up being a winner if I had just held on to the strike till expiry. All right, so if you have any questions, leave them in the comment section below. Like always, if you can open an account with Questrade to trade on the stock market, use my referral link below to get $50 in free commissions. Thanks for watching.